Hey traders, happy Monday. Welcome to the weekly outlook. This is Chris Pulver here. We'll talk about stocks, Forex, cryptos here in just a moment when we get into the charts. Elon Musk, pretty incredible story. Tesla becomes the world's most profitable automaker, market cap exceeding 220 billion, which surpasses Toyota, which is around 200 billion. Tesla, however, has yet to make a profit. So interesting notes. What do we have here? We've had the sales on Tesla for the last couple of quarters have been fractionally lower versus for GM, Toyota. Sales plunged like 30%. So Tesla's hanging in there, hanging strong, and of course the stock is being priced in as possibly the automaker disruptor. And share prices are up over $1,200. It's an amazing recovery from what we saw back in March at the dip at 366, and we just soared up to new highs over $1,000, rallied up to 1,200 plus. And seems like, yeah, you got a CEO that says it's overvalued, but investors and buyers don't seem to think so. In addition to that, read some interesting articles this weekend. It sounds like we have some races to the coronavirus vaccine with some big players. We're talking about Pfizer, BioNTech, Moderna, Johnson & Johnson, all talking about having certain doses by the end of 2020. So their stocks are jumping as well, with some positive and optimism coming around coronavirus, despite cases just going nuts, especially here in the U.S. I also read an interesting article on the Fed ready to buy actual stocks. There was some contract work going on between BlackRock and the Fed, and it looks like the Fed has taken some notes out of the Bank of Japan and the Swiss National Bank, which allows them to actually buy stocks and have holdings. So, for an example, Bank of Japan has, I believe, 70% of the Japanese ETFs in holdings. And the Swiss National Bank, I believe, has over $100 billion in U.S. stocks. So if the Fed is taking a page from those central banks, right now what we're seeing as we head into, we're still in summer trading, head into post-summer trading, getting into a U.S. election, the Fed right now has the markets back. The Fed is willing to step in and increase the balance sheet, take on the extra debt. Whether we think this is sustainable or not, this is certainly something that's probably not going to allow the market to fall at this time. And again, we probably know that it will end badly, but I'm certainly sick of fighting the Fed. I'm not going to be holding, short positions on the stock market at this time. If I'm interested in playing something, it might be volatility over the next 2 to 3 months. I think volatility will increase. So that's probably things I could look at like TVIX and VIXI and ETFs like that, or also just playing options on the VIX. But anyway, interesting developments over the weekend. So let's get started. Before we dive into the charts, understand there's risk in trading. This is for educational purposes only. Please don't trade with money you cannot afford to lose. If you're out there, follow me on social media. I'll show the handles in just a moment here, but I have a free educational series called Keep It Seriously Simple. Trend line, support resistance, price action, patterns, trading on MetaTrader 4, trading different charting platforms, choosing a broker, stuff like that. All free education out there on my YouTube channel. You can just search my name, Chris Pulver, or look for Keep It Seriously Simple on YouTube. If you're following me on other social media outlets, Instagram at pulver.chris, Twitter at pulverchris, Facebook, YouTube, just type in my name. All right, let's go into the charts here. I want to start off with the dollar index, actually, for this reason. We talked about this in my trading room the last couple of weeks, looking to see, will the dollar start to fall? I mean, structurally, we had all this volatility from a declining dollar and then super strong dollar with high volatility once we found our, this was essentially the safe haven flow through the early part of March. Once we found a bottom in the stock market, we started to see a top in the US dollar, and it has been slowly and steadily working its way back down. Now, it does appear to be heading back down into equal lows. Now, I would look at this overall structure. Here's a daily chart. Let me see if I can park that. Here's the daily chart, and let's go to the weekly chart because this could be setting up for a really large range on the dollar index. So we had a previous high back here in January 2017. We had our high this year in March 2020. Now, a couple big levels that I'm looking for. Look at all this previous support back around 11,560. Again, this instrument or the symbol is US dollar. So if we come back into those same lows, I mean, there's a couple of intermediate levels now that the dollar looks like it's going to fall. The question is, are we going to fall all the way back down first, or will we remain consolidated with between probably levels like 12,100 and 12,300 to 12,400? So we'll take a look at the daily chart in just a moment. But I do think that this structure high, this 2017 high to 2020 high, does set up a really good resistance level on the US dollar and likely leads it to further declines. We could also see, with the Fed's expanding balance sheet, and it looks like, no end in sight, and the Fed is kind of single-handedly taking the reins to save the stock market, stabilize the markets, to incur, $3 to $4 trillion of excess liquidity. If they keep that going into the rest of this year, I mean, we might see a, $5 to $6 trillion package from the Fed just in 2020, which again sounds horrible. But I just found an article over the weekend as well that talked about there's too much debt in the world. There's too much power in these banks to really have the stock market fall. Certainly the Fed doesn't want to be blamed for the stock market falling, and right now they're kind of artificially propping it up. So it's they're prepared for a lot of different things. They still have the plan to buy stocks. It looks like all that paperwork is going into effect with BlackRock, and if they have to, that's kind of the ace up the sleeve if needed. Which again just kind of leads me to believe that what we are seeing is lower volatility, drifting higher, a very significant reluctance for the markets to fall. So rather than trying to fight that, let's see where the flows actually sit. So with the dollar index, we're looking for, strength in the Aussie, strength in the New Zealand, probably strength in the pound versus the dollar. Structurally on this weekly chart, we will likely see this US dollar index falling back into levels like 12,100. There was a yearly pivot from 2019 at 12,032. So this wouldn't surprise me if we have, this trend line is breaking. I'll go to the daily chart here in a moment. Trend line's breaking. We're probably heading back down into slightly lower lows. So I'm curious if we have this high to low, shallow pullback, but trend line breaking. If we push down into equal lows into this, yearly pivot from 2019, is that enough to start warranting a corrective move, a wave pattern, and then we start working our way back down into a more significant support level? So if there's going to be some wave structure on the dollar index, we still are probably not going to trend all the way down into those 2017 and 18 lows. However, I think that's ultimately where the destination is for that dollar index. And if that is the case, traders and I have already talked about, if dollar index is going to drop that much, then there is a pretty big plan to be long euro dollar, pretty big plan to be long pound dollar, pretty big plan to be long Aussie dollar, New Zealand dollar. But the timing of that, we're going to look for some wave structure and levels to buy some of those dips. So when we talk about some of those currency pairs, keep that in mind. Okay, let's see here. SPY wise. Let's go to the SPY really quickly. And you can see that last week we are continuing to fight back from that nasty sell-off about 4 weeks ago. So we have 1, 2, 3, 4 weeks ago was our really nasty sell-off in the stock market. That was pretty much wave 2 concerns for coronavirus. Doesn't seem to be going away. Cases are hitting all-time highs. Daily cases in the U.S. are extremely high. Certainly not flattening the curve. Reports are that certain states are going to be overrunning the hospital, the healthcare system. But hey, we're looking past it, right? We've got vaccines on the horizon. So anyway, the market is reluctant to fall. I did say that if we break these lows, which are around 295. If we break 295, we're looking to go down towards 270. If we break the highs at 320, then we've got February highs at 335. Now, even if I am buying, if we see a break of the highs at 320 on the SPY, momentum will likely carry us into the highs of February. Now, whether we can say or argue or justify that we are in as good of a position and the stock market means that everything is great for those that have assets and holding equities, I mean, are we in the same position we were back in February? Are we in the same position we were back 6 months ago, 12 months ago? Of course not. But the stock market seems to think that we are getting through it. Or is it the Fed? Is it the propping? Is it the safety net that's keeping us afloat? So I think if we do get to these highs, any stock positions that you're in, move trailing stop losses, protect your profits, don't let anything go against you, be firm on that, and look for holding companies that you want. I mean, look for holding companies that are going to stand a chance for any type of, ugly sell-off once again, which I do think is coming. I mean, all these major corrections we had in 2018, 2018 again, 2019, 2020, all these big, fast drops that seem to scare everybody, the market found a way to fight back. But as soon as we challenge those highs, it falls. We challenge those highs, we fall. We challenge the highs, we have a bull trap here, overbought bought divergent conditions, and then we had obviously that snowballed with coronavirus and huge drop. But again, we fight back. So I think this leads us to more volatility ahead. If we do end up breaking those highs or challenging those highs, I think something's going to allow this to drop quickly. And thinking of the timing as we get through, we kind of coast through July, there might be some volatility here and there. But August is usually one of the more sneaky volatile months. And then we have our post-summer breakouts coming in, middle to late August into September. Traditionally and historically, September and October are pretty terrible months in the stock market. And you consider that little factoid with a US election coming up in November, we are going to see a lot of volatility in the coming months. So that is something I'm definitely getting ready for. I'm getting ready, with my strategies. I'm getting ready mentally. And I'm making sure that, we're not being lulled into complacency or thinking that like, oh, it's super calm right now and getting a lot of risk and exposure and, just a lot of trading, which really wouldn't suit me if things start to change radically, because that's exactly what happened to me in March. I had a lot of good positions. They were all pending levels, pending highs, pending lows, and the market just decided to blow right through them. And that certainly caught me on my heels a little bit. So I had to do some drawdown management in March. Worked out okay. It was a great, April and May, but it was certainly a couple of weeks where I was very focused on that risk management. So that's what I'm prepping for. A lot of mindset stuff. Stock wise, can't really find something I want to buy. The good thing is, I'm trading with Robinhood in addition to TD Ameritrade. So my Robinhood stocks, I can buy partial shares. So if I just want to put in some cash, which I did, park some cash in Tesla when it was, on its way up towards, 700, 800 again from the dip in three. It was like 366 was a low around 400. I bought a little bit, but I took some profit. I bought a little bit more again as it broke through 1,000. I've cashed out of that. So I've done a lot more short-term trading in stocks than I have in a long time. I'm looking for kind of the next big position for me to be parked in volatility. And just trying to wait for some opportunities to buy nice and low at some companies that I want to hold at better prices. Stocks that I picked up back in March and April that I cashed in on. I want to buy them again, but I'm just not going to buy them at current levels. So anyway, that's that. Otherwise, for the stock market, watching, reading the news, it's frustrating to see that there's just no reason that the stock market wants to fall. But again, remember, the reason is the Fed. Right now, I mean, if you look at the earnings reports, which are terrible, as far as corporate earnings, Q2 was awful. Q3, the forecasts are being slashed. But you have to remember that there's a mindset, there's a psychological factor with sentiment. And here's what I think. Everybody suspects that the stock market's going to fall. And that herd mentality is usually what Wall Street is trading against. That's usually what institutional money is trading against. So if the retail investor is parking into bonds, parking into treasuries, parking into cash, there's no yield. That's safe, that's stable, but there's no yield. So it forces them to make a decision. Do they want to put money back into riskier assets like equities? I think if we stay safe, then equities rally. If we park it into equities at the highs, equities ends up dropping. So I really think that at the end of the day, this is just kind of a big mess for retail investors in the end. So the good thing is having some trading proficiencies and having some knowledge out there with what to do and how to manage some money, we can be profitable on either side of it. We can have things parked and we can make money on riskier assets and equities and in currencies. We can be invested as well in safe havens so we can benefit from that. We can trade instruments like inverse ETFs and volatility that will be very profitable in a very short amount of time if the stock market does have a nasty spill once again. So, risk is super important right now. Considering how you can possibly hedge. So if something goes really well or something goes really wrong, something goes really well, and that can balance out to either offset or, of course, what is winning is going to offset and be more profitable. So, hedging is an option out there. Diversifying is certainly an option. Risk management is really critical. So this is all, I mean, these are huge macro themes in managing your portfolio and being diversified because there is a lot of volatility that will still be happening. I would suspect for the next 6 months, this probably won't be the last time we're like, wow, what a crazy move. We've already seen 2020 as one of the wildest years we've had in probably a decade. And we're just wondering, what does it look like? How does it end? We don't know. So with that uncertainty, there are things that we need to do to make sure that we are, bulletproof in our bottom line and make sure our portfolios are battle tested. So Anyway, let's get into it for this week. I'm going to take a pretty similar stance from what I have for the last couple of weeks. I know the Aussie's getting a little bit stronger. The New Zealand's getting a little bit stronger. I was looking for some major resistance here on the Aussie CAD. Let's take a quick look at this. Let me go to the daily chart on the Aussie CAD. We are stretching into, once again, overbought conditions. Let me take a better look at the highs. So we've just kind of been drifting higher. You can see here my little trend line has not officially broken. I do have some sell stop orders waiting to get filled. So if we see there's definitely a lot of disagreement between price. Price is making slightly higher highs with today's candle. Disagreement here in momentum. And we're right back here parked to the top of this relative strength index. So I'm looking for some indecision or just a simple break of this trend line for the Aussie CAD to fall back into levels like 9100 or lower. I think we come back to this equal low, which is this candle low around 90.63. So 9100, 90.60, 9000 is a round number. That's where I'm looking for some profits on the Aussie CAD that I'm holding short. But it just continues to drift a little bit higher. New Zealand CAD is very similar, drifting higher. I have some major resistance on New Zealand CAD between 8,900 and 9,000. Let me type in New Zealand CAD there. So there's a really nice daily harmonic pattern. This is one of my favorite technical setups. Again, haven't broken the trend line. So if we're looking to keep this really simple on a trade like this with some technicals, a trend line break is going to be super important on this New Zealand CAD. Once we get it, then everything lines up really nicely for this to fall back towards 86.50, 85.50, possibly more. If we go to the weekly chart, we should see a resistance channel high right around 9,000. Yep, it's right there. So you can see this goes back to 2016. Resistance, 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 and we're testing that level once again. So from this recovery, we have a low to high swing, pullback. We're heading up towards most likely a 618 extension. So this low to high swing, fulfilling that movement around 8,900 to 9,000. Major resistance in this weekly channel that goes back 4 years. So could we go a little bit higher? Sure, we could test those levels and make people think that, oh, it's going to break that level. But look here, look left. Previous support becomes resistance. That's right around 8,900. So there's a strong level there, and then also 9,000 is a firm round number resistance point. So between 8,900, 9,000, looking for some indecision. I'm looking for, better disagreement between, I think I have it on the daily chart, but the weekly chart, are we overbought? Not yet. On the weekly chart, do we show disagreement with momentum? Not yet. On the daily chart, we do. So here's the daily chart. And we're starting to stretch. So what you can see here with price making new highs, slightly new highs here for the last 4 days, disagreement in momentum. Making new highs, we are getting back to a very close, not quite touching it yet, but close to overbought conditions. So what's the easy trade? Look for some indecision up here towards 8,900 to 9,000. Look for a trend line break. I would say within the next probably 20 to 120 pips, we're looking for some major resistance and some major bearishness to at least start to line up and confirm. How does that line up with summer trading? I mean, July kind of seems to be adrift. We just came through a holiday week last week with Friday was a bank holiday for the U.S. Get into this week. Do we have any major news? Let's take a look. Here's the economic calendar for Forex. You can see that's a very light calendar. I mean, last week was pretty quiet as well as we headed into the holiday weekend. This week, major impact news that sticks out, cash rate decision and statement from Australia. Official cash rate will likely stay the same at 0.25. It's what they say. The central bank statements have been very similar. RBA, RBNZ, Bank of Canada, Bank of Japan, the Fed, they all know that there is uncertainty ahead. How are they going to, prepare for the risk? How are they positioning themselves? They're keeping cash rates really low. There is discussion of zero interest rates. There is discussion of maybe negative interest rates if needed. I know the U.S. is opposed to that, but most likely everything right now stays the same, but the statements will be at the very least neutral, but most likely neutral to dovish is kind of the tone and everything. We have CAD employment on Friday. We had a crazy job number last week on Friday for the U.S. Everyone is all excited like, oh, the U.S. made 4.8 million jobs. It's like, but they didn't. These are just jobs coming back. Average hourly earnings are worse. Unemployment rate is still incredibly high, but it's just like anything to spin it to make it sound like it's better. It's not better. It's not good. So I've said this for the last couple of months. Since coronavirus has thrown off forecasts and made things very uncertain, I think that the numbers, the data is not really going to tell the true story. Yes, there are things we need to consider and pay attention to with the trends. But we have to follow price. So it was a pretty non-eventful Thursday morning. We traded together live during my trading room and didn't see a lot of excitement out of the markets going into this week. RBA rate decision, CAD employment. Out of the stock markets, we have earnings from Paychex, Levi Strauss, Bed Bath & Beyond, Delta, Walgreens, Infosystems. We have weekly jobless claims as well on Thursday. I'll have to turn this into a medium and low impact because that's what we're categorizing that as now. So here we have unemployment claims for the U.S. Thursday morning at 8:30, and producer price index for the U.S. that follows right along with the CAD employment on Friday. So let me give you some goodies to walk away with for the weekly outlook. I really like the New Zealand CAD. If you are long in this and holding long, I mean, it's a great spot to be protecting profits, moving stop losses below. This previous candle here, we had 4 days in a row with today included, so 4 bullish candles on the daily. Look, put a stop loss in below this low, trail it up for the last couple of days. Just keep moving your stop loss. If we make new highs, then keep moving that stop loss below the previous low. Once we get to 8,900 or 9,000, I'm expecting some major indecision. We might end up matching that overbought condition. We start looking for trend line breaks. Once we break this trend line, this will probably fall back in towards 8,600 or 8,550. Aussie CAD is very similar, just different numbers. If we end up stretching a little bit higher into 90, we're currently trading at 94.50. Do we get to, a round number like 9,500? Can we break this trend line? So I'll make a slight adjustment right here, just a smidge. But once we start showing more indecision, breaking the right side of the trend line, disagreement is there. Overbought conditions we already had them. It's just a matter of are we making them a little bit more extreme? If so, that extreme sets up for the Aussie to fall. And I really like those currency pairs. I like those 2 trades for this week and watching. Pound Aussie is another one. I actually got filled on a couple levels on Pound Aussie. I talked about this in my trading room. I got filled at 79.20. And I put in a small trade last week at 8,000. So I am in a small drawdown between 8,000 and 79.20. That's 80 pips. So my break even is around 79.60. And that's fine, 79.60. And here's why. It's part of my right trader strategy. And I really like this setup on a 4-hour chart. Some of these Aussie pairs from some of the technicals that I'm really fond of are extremely overbought or oversold, or the bar count that I see is really, really overstretched. So in other words, I'm looking for this area to basically hold around current levels around 7,900 and look to see if we can hold these equal lows, maybe drift a little bit lower, which I do have a opinion buy at 76. But I'm looking for price just to find a way to either start transitioning sideways and then start going back up and correcting, or drifting slightly lower and then making a bigger move to the upside in a more violent kind of sharp trend fashion. But this red ribbon and this shaded zone, I have a really solid bar count, really good probabilities that they're going to get hit. So if we have equal lows here and they come up, fantastic. So I'm looking for this, red ribbon area, which is around 81.75, or preferably this shaded zone, which is around 82.75. I mean, that's anywhere from 200 to 300 pips off of current price. So that's kind of my favorable direction once I get a bit more confirmation. I do need to see price turn blue on this. This is my right trader max system. So if price turns blue, I'm in. I told traders this last week I have some buy stop levels to start buying in this area to aggressively target that red ribbon and shaded zone. So I'm kind of testing the waters now with some small trades. If it comes down to 7,600, I will buy it again. But I will have some buy stop levels to take this aggressively back towards that shaded zone and red ribbon. There's also a really nice inefficiency. I call this a pocket all the way back up towards 9,100. But again, I'll take little bites first. So if I can get some equal lows and we run up towards 8250 to 8300, that'll be a nice profitable trade for this week. Meanwhile, I mean, if I'm picking a currency pair, that's pretty much it. Aussie CAD, New Zealand CAD, Pound Aussie, technically are some of my favorites. I am watching the dollar Swiss. I had a chart alarm go off on dollar Swiss, and I think I may have had a trade fill on the dollar Swiss. Let me take a look. It's right at it right now. So here is my MetaTrader 4. And I'm sitting here with a small drawdown in dollar Swiss coming back to equal lows. If I take a look at this on the 1-hour chart, this gets me pretty excited. Come on, man, just fill me at this level. Go down like 2 more pips and fill me with that spread. So I'm looking for this to recover. I think that, long term, we're still looking at major support around 92.50. If we come back into this 2015 flash crash low, we may drift down into 9,000, maybe 9,100. But long term, just with, even though the Fed has cut rates to 0 and 0.25%, the Swiss National Bank is still at negative 0.75. So this trade to me, longer term, I'm going to hold it. I'm going to turn it into a carry trade and just get positive rollover. So I'm going to buy it. I'm going to buy it at 92.50. I'll buy it at 8,900, and I'll hold this long term. I think we can still get back into this massive level with, crazy support from this 2015 Swiss National Bank, anomaly to lows around, 8,400 to highs around 1.03. So I'm willing to take, small trade, small trade, small trade, get some positive rollover, take it back up and play the range from, let's say, 9,000 or 92.50 support all the way back up to 1.00 plus. So I will stay long on the dollar Swiss. Some of the other instruments that I'm watching, I talked about playing volatility. Here is one, the VIXY. VIXY. Let me go into a daily chart. So right here. So we have the VIXY starting to come off those lows from last week. Now I was watching, I want to buy it lower. I'm not as excited like I was earlier this year to, short the stock market. I was geared up for it. I had inverse ETFs that I was long on, double and triple leverage inverse ETFs on the SPY. I was long on the VIXY. I was long on the TVIX. I was long on the UVXY. All those paid, 300 to 600% profit in March. It was incredible. It happened so fast. It was a great way to, make some profits that were being anticipated. But now, kind of the second go around, is this a reflection of, are we going to see sustained higher volatility? Are we going to come back and, push back down to the lows again? Look, if the VIXY came all the way back down to those February and March lows, I'm definitely going to buy it. At this level, slightly higher, if I bought it, I feel like I'm going to sit on it for maybe the next couple of months. One thing you have to be careful on, especially with ETFs, if they are double and triple leverage, they are subject to repricing. They are subject to splits. So I did experience that back in March. I bought the TVIX, and that was a triple weighted ETF, and there was a 10-to-1 reverse split. Now, at first, I was like, oh, that's bad news. I bought this thing at like $10, had a 10-to-1 reverse split, so my break even was $100, and this thing rallied up to almost $1,000. So it paid out extremely well, but it was a weird repricing after a split because a lot of times that happens. Sometimes those stocks or instruments don't fare very well. Oil this year with the May contracts finishing worthless or in negative territory, same thing happened on UCO and USO. They were repriced, there were splits. I'm still sitting on a couple of those instruments. So it doesn't always work out in your favor. But what I'm saying is, if we come back down to these major lows from February on a volatility instrument, I'm probably going to go long again. Now, do I expect a similar rally like we had in March? Probably not, but I do think that volatility is going to pop back up, whether it's now, 3 months from now, 6 months from now. As long as I'm willing to take a small position, allocate it, and get some play on the volatility, we should get paid out pretty nicely on that. So, stock wise, I'm waiting on stocks themselves. I cashed in a lot of short-term positions in April and May. I do want to play volatility, but I do want to wait for great levels. I want the TVIX to come back down, the VIXY to come back down, the UVXY to come back down. I would like to see, the SPXS, which is an inverse ETF on the SPY. I'd like to see it come back down. So you can see here, we're already at lows again, right? I mean, we're back to these lows. I bought it. I had this thing holding from January 2020, held it for, a couple of months, and then got paid really nicely. We're back down to fresh lows. But you have to, you basically, you're making a bet right now that the stock market's going to drop. You will probably be sitting on this position. Does it pay out? Will it pay out? Probably, but it might take 6 months. It might take until the election. So in the spirit of not trying to time this, if you wanted to sit in it with a small position, you don't have to worry about the timing. But if you're trying to time this better, I think we're going to be oscillating. All right. I think we're going to have some, sideways volatility if we're sitting here near these lows, and we're coming into October. Sure, I can take a chance on that in October. Most likely going into November, December, we're going to see a ton of volatility in the markets, and that volatility is good. Remember, SPXS, SPXU, those are inverse ETFs. The only way these will rally is if the SPY drops. So if for some reason we see higher volatility, but also a bullish stock market, these instruments will not do very well. So that's why I'm more likely going to play the VIXY the TVIX, the UVXY instruments like that. I do think that volatility is here to stay. So I'm trying to find some good levels on those instruments to play. Stock-wise, I'm waiting. Currency pairs, I'm hand-picking. We have some great technicals. I think the Aussie is a great basket that is overstretched. I like that pound Aussie. I like the Aussie CAD. I like the New Zealand CAD. Aussie New Zealand, I'm still waiting on a good level on that one. There are some good currency pairs. I mean, we have 28 that we analyze every single week in my trading room, and we're finding some good ones. We put in some pending orders last week on the euro dollar. We have that pending order on dollar Swiss. I think we traded Swiss yen. We put some levels on euro CAD. So we have some levels that we're just kind of sitting out there for some highs and lows to get tested, especially if July stays kind of range bound. But again, we'll just kind of let things unfold, let things play out. And meanwhile, one thing I want to make sure that I'm making traders aware of is, even though it seems like, I'm fairly inactive right now, I'm really not. I have robots running in the background that have been doing extremely well. If I take a look right here, I have a strategy called the Perfect Storm, and it has two specific robots that continue to trade. If I look at one of them from last week, so let's see here. So far for the month of July, so 6 days into the month, I'm up 389 pips on one of these robots. This week, I'm already up 100 pips, so I must have closed out positions overnight. That is I think that's the range storm. Yes. So let me go into the active storm here. Active storm typically calls a little bit smaller profit levels, but so far this month for the first 6 days, and not a lot of trading days, obviously, it's up 90 pips. So, last week, I think I looked between my perfect storm strategies and my equalizer, collected close to 1,000 pips over the last 2 weeks. So even though I personally am not doing a lot of trading, you have to remember, what are the current market conditions? There's a lot of choppiness. There's a lot of indecision. There's a lot of low volatility. It's easier for me to let a robot trade that low volatility, trade that indecision, than it is for me to go in to, 4 different currency pairs, 5 different currency pairs, follow these highs and lows and try to scalp them. The robot does that for me. So that's the Perfect Storm. That's the Equalizer. Those are great robots to be running right now. And I've been very vocal about them in my trading room. I mean, I think they're fantastic robots. So I do think that I will turn them off most likely in the middle of August to avoid them getting into too much trouble. And I'll start switching over to names like Right Trader. It's a great robot, Right Trader Max, my Momentum Breakout Max, which is going to be one of my favorites heading into this year. I mean, middle of August, Momentum Breakout Max, I'm letting that thing run for the rest of the year. I have it set up in such a way that regardless of what happens with volatility, regardless of what happens with the election, even if I'm on the wrong side of the initial move, I will be right on the big move. So if we have big moves coming over the next 3 to 6 months, I will definitely be following them. And when I'm following them, I'm going to be aggressive in adding to my position. So I do expect to have a good, solid remainder of the year. I'm just being patient right now. I'm making sure that I have plenty of margin available to be diversified and position myself accordingly. And I would say that that's probably the best step moving forward. So that will about do it for today. I would love it if everyone, smashes that like button, subscribes to the channel. If you have any questions, you can send me messages. I mean, I know they're public comments, but I do reply to them on YouTube. You can send me a message on Facebook or DM me, direct message me on Instagram. So this video and many more get posted on my YouTube channel. Just search my name, subscribe to that channel. I also post the weekly Outlook videos on Instagram TV or IGTV. So you can find me out there on social media. Subscribe to the channel, like the video, pass it on. If you have other people that can benefit from this education, these weekly outlooks, and just have some commentary running on what the fudge is going on out there, and help traders, help investors, get through these next 3 to 6 months, get through these uncertainties, and not experience an awful dip. Not let your wealth, your retirement, your pension, your 401k experience what probably most people aren't ready for. I mean, yes, it's great that the central bank stepped up and we had a 40% recovery off the lows, but everyone forgets how we got there. A 40% recovery is because we had a 35% decline. That's essentially getting back to break even. So that process of dropping and getting back to break even, dropping and getting back to break even, that just means you're not losing money. And again, if you think about the psychology of that, what happens when these big sell-offs occur is that people drop positions. So at the lows, people sell rather than aggressively buy back in. So in order to make money in this rally, you have to buy those dips. If you're losing money and you're panicking and selling, you're typically not buying back in. You're just getting out of everything. So it's been a very difficult couple of years for the trajectory to be sustainably higher unless you're adding more at those bottoms. So I think now is the time to preserve and protect. And if we have another drop and have another dip, which I certainly hope from the technical standpoint and an 11 plus year bull run, that we do have some type of correction. But we're seeing a reluctance right now. We're seeing that there is a propped up market. We're seeing that it's pretty much in lockstep with the Fed balance sheet. The Fed is taking a lot of steps to make sure there is stability because they don't want to be blamed. Now, maybe after the election, the Fed takes a different tone, right? Maybe they're not going to be blamed. Maybe it's something else. Maybe it's a change of administration. I don't know. There's a lot of things that we can't know what the cause is going to be. But that's what I was saying. The sentiment, right? The psychology. If everyone thinks the stock market's going to fall, it's probably not going to fall right now. It's going to fall with something else that maybe that's not even on the radar right now. We don't know, but something's going to happen, and so again, we need to be prepared. We need to be ready. We need to be nimble. And that is kind of a day-to-day, week-to-week approach. But that's what gets us through and make sure we're not doing anything stupid when all of a sudden we're noticing like, wow, this market's going crazy. Well, right. So we planned for that. We prepared for that. Now, how do we take action to trade it? So that's it, traders. Have a great week. If you need me, send me a message on YouTube, leave a comment, like the video, subscribe to the channel, send me a message on Facebook, tweet me, or DM me on Instagram. All that social media stuff. All right, traders, have a good week. I'll talk to you soon. Bye.